Hello and welcome to Policy Watch, your packed snapshot of the week's biggest business stories, their context, their relevance and impact. I'm Govindraj, Ethiraj. This week, the Indian stock markets experienced a steep fall thanks to crude prices plunging to levels below $50 and possibly headed even below $40. They, however, recovered towards the end of the week on positive global cues and a halt in sliding oil prices. The BSE Sensex and NSE Nifty saw massive selling on Tuesday and lost 3% of their values on a single day. The BSE regained the psychologically crucial 27,000 mark and NSE closed above 8,200 on Tuesday and Thursday and continued the positive streak in the early trading hours on Friday. Globally, most Asian markets closed up and European indices were trading firm on Thursday. The positive employment data from the United States and strengthening of Indian currency towards the end of the week also helped cement gains in the markets. Confidence was given by a much needed boost from the US Federal Reserve's December meeting that suggested the US Central Bank will not hike interest rates before April. Oil prices were also trading firm in Asian markets in the last trading session of this week, but some concerns remain due to excessive supply of that commodity in the global markets. To understand the significance of this fall and whether it could indeed continue, I'm now joined by Prakash, Chaturvedi, market analyst and former CEO of L&T Mutual Fund. Ved, thank you very much for speaking with us. Ved, tell us, so we started the year on a seemingly optimistic note and there was this sudden shock where the markets crashed 900 points in a day, which is of course unusual and one of the sharpest falls that we've seen in a while. Why did this happen?
I think three reasons. I think one is global geopolitics. We know that it is anticipated that this year the Eurozone will face its own set of challenges, particularly with the change in the ruling configuration in Greece. There are chances that there will be some pulls and pressures and an outside chance that Greece may actually exit the Euro Federation. And all that is playing on the market's mind. The sharp decline in crude prices, commodity prices, is also playing in the global investors' mind, and the impact of all that and how that will play out. And last but not the least, let us not forget that the Indian markets have run up very sharply.
Right.
There's a 30-40% run up that's happened in the last
2014. Yes.
So I think some of that, some profit taking, etc., etc. And don't forget one thing: towards the end of the year, for various reasons which you know about, markets are normally kept at a particular level. I mean, they stay at a particular level. So I think after that, some of that may have unwound.
Yeah. Is that because fund managers go for vacations? Also,
yes, so various things. Yeah.
Okay. So let me ask you the question. You spoke about crude oil. Now the perception sitting here in India is if crude oil prices are falling, commodity prices are falling, it's good for the economy because purchasing power goes up, our ability to spend goes up. But that's not the way the markets are seeing it because there are other factors at play. Walk us through those.
Sure. So I think, if we sit back and think about the next 1 year and we think about the major factors that will drive Indian equity markets, I would say that there are primarily 5 factors. First and foremost is actually the policy action of our government. Because India has always remained a very domestic play. Bulk of our earnings comes from domestic factors. And there is encouraging news. The recent activity in the area of ordinances for insurance, for land acquisition, etc., etc. While clearly early signs, but the intent is clear, and I think that is a positive. Second big factor, I think, in this year is the global decline of commodity prices and crude prices. As you rightly pointed out, that is a positive for our economy in the long term. However, in the short term, a number of companies in petrochemicals, in oil and oil-related industries, etc., etc., will have earnings issues, and some of that gets reflected in how market is evaluating the situation.
Okay.
Third big trend, I think, will be the fall in interest rates. And we have seen that in the past. You think
it's an anticipated fall in interest rates?
I think actually interest rates will be cut, and I personally feel that when we are similarly speaking 1 year from now, I think we would be, to my mind, looking at least 100 basis point cut in interest rates over the year. That's my personal view. So I think that would clearly be a very positive for margins, for corporate profitability. And last but not the least will be the issue of global fund flows and liquidity coming to India. My feeling is that if you look at all these factors, the global geopolitics is certainly a challenge and will play on global investors' minds. And since a large part of the incremental money that comes to Indian equity markets comes from overseas, that issue of geopolitics will cause from time to time these surprises that we saw early January.
Right.
But my feeling is that investors need not be spooked. As long as the fundamental growth story of the Indian economy is there, there is a cyclical turnaround that's coming. There is a policy framework that is becoming more robust. And I see no reason why over a medium-term time frame, earnings momentum should not get reflected in a more positive
So
market
our
trend.
markets are, I guess, which is a fact of life, are dependent on foreign flows. Foreign flows will be driven by various considerations which are beyond our control, including, let's say, money managed by sovereign wealth funds and so on and so forth. So that's one part of it. Let's look at the Indian economy or the Indian companies that you spoke of. A CRISIL report that's just been put out says revenue growth is at a 6-quarter low for Q3 FY15, which is really this quarter. So, I mean, while they're saying that there are some good signs on the horizon, including marginal uptick in earnings before interest, tax and depreciation margins, but the overall mood seems to be one of concern.
Sure.
So how does
So I
that
think the
play?
overall mood of business in India, if I may use the word, is really wait and watch, but watch very closely. And I think this quarter will be the quarter where you see early signs of, like you said, margin improvement. Let us not forget that margin improvement really precedes upturn in business sentiment and upturn in revenue growth. So I think we are at that point of the cycle where people are waiting and watching. There is a sense of optimism, there is a sense of apprehension, and as we see margins improve and ROEs improve, don't forget that Indian ROE right now is almost the lowest it has been in a decade. If I remember correctly, it's somewhere around 16%, which
Return on equity.
ROE, return on equity for various companies.
Yeah.
Now this used to be 20% plus, and at the peak 25%, etc., etc. So I think there has been a huge decline in ROEs. Business owners want return on equity. As they see that improving, confidence hopefully will return, and in turn top line growth may.
So two constituencies that are in some ways likely to be affected by this, positively or negatively. One is the government itself, which is a large owner in equities and is looking to raise more money from the secondary markets. And secondly is the investor who's wanting to get in, and we're talking about the small investor. How would you, what kind of prognosis would you offer to both?
See, my feeling is that as far as government divestment is concerned, it will have to be planned out and over a period of time. Because while there is appetite, there's only that much appetite. And with efficient markets now, you can only sell high quality stock to the market. Within that caveat, there is appetite, there is demand, particularly from overseas investors, there is demand. Now we see also money flows coming to Indian equity mutual funds. So within the limited context of what is flowing in, I think the divestment program will go through. From a domestic investor's point of view, we all know that in India, equities are under-owned, right? I mean, the mutual fund industry is an example of that. Out of the 11 lakh crore of the industry, barely say 30% or 25% as equities, the remaining is fixed income. So I think we will see a huge shift of people going from fixed income to equities, savings shifting from there. Mind you, the smart money has already shifted. I mean, ahead of the bull run that we saw, and increasingly we will see more conviction as returns become more robust. And I would not be surprised that over the next 5 years, this percentage of 25% becomes 35% and 40% in the mutual fund.
Right. So, I mean, coming again on the heels of a sharp fall this week in the markets, would you advise investors to invest with caution, not invest at all, wait and watch?
I think there are simple 4 mantras of long-term investing in equities. One is look upon it as a savings avenue. So like you put money in bank for some reason, put money in equities, because the long-term return profile of equities is now established. So second point, which is put money only for the long term. Thirdly, put money with either well-managed funds or into well-managed companies that you can analyze. And last but not the least, ensure that you are tracking your investments closely, whether it is funds or equities, and taking appropriate action in case you think that performance is not up to your expectation. If these 4 mantras are followed, and if a person does not put money for short-term speculation but for medium-term, in line with the return profile of equities, I think there is no need to worry. In fact, I think it is a pity, actually, I feel, that Indian investors, if you look at the last 15 years or 20 years, have not taken full advantage of the returns that actually Indian economy and Indian equity mutual funds have offered.
Right. But Indian investors, I mean, would also be worried and apprehensive about the kind of blips that we are seeing, right? Which are as we discussed, beyond our control, because the capital in the markets is largely coming from overseas. The triggers that are happening to drive this capital are also overseas, and many of them we don't know. Some of them we do. The oil being the most evident one, or the Greece economy factor, but there may be others, including geopolitics.
As we know that in the short term, markets react to the news of the day, to fund flows, to sentiment, etc. Long term, markets react to the earnings growth profile of the economy and the country, and long term markets are a barometer of economic growth of an economy. We have no doubt in our mind that the long-term potential, long-term, 3 years, 5 years of this economy, the fundamentals are robust. Short-term, let us be absolutely aware, let us not fool ourselves. There will be blips, there will be sharp falls and rises. Investors should just think about this from a medium-term perspective. Ride out the short-term blips, use falls as an opportunity of entering the market, and hopefully study the long-term profile of equity funds in India. As I have said, there is now a 15-year, 20-year track record of several mutual funds, equity funds available. And if you look at that track record, study carefully and invest with caution, there is no reason why you need to be concerned.
Right. So, fundamentals of the Indian economy are strong. Corporate earnings, while they may be slightly under pressure right now, will recover, is what you're predicting. And of course, the larger Indian economy story is still sound. I mean, that's going ahead.
Oh, absolutely.
Right.
Absolutely.
So, let me ask you the last question. So, when you look at all of this, I mean, again, for investors who want to enter, what are the kind of areas that they should be looking at? What are the sectors, I mean, that are looking stronger at this point, and what should they be a little more wary of?
So I think from a very macro point of view, given the trends that we mentioned, which is falling commodity prices and falling interest rates and policy action, etc., sectors linked to, say, commodities, hopefully, which we've spoken about earlier, petrochemicals, oil, etc., may not do so well. Chemicals may not do so well. However, there are certain other sectors which have not really performed as well in the last few years, which is maybe automobile companies, banks, building and construction companies, equipment manufacturing companies. And if this economy has to double its size in the next maybe 5-7 years, 10 years, then it cannot be done on the back of the infrastructure that we have today. All these companies, whether it is construction companies, material companies, companies who are going to make equipment, and automobile companies, have to all do well. So I think that are segments which investors should look at. Again, I repeat myself that it should not be done from a 3 months, 6 months, 1 year perspective, from a medium term perspective. But if India has to be built, it will have to be built by us. By us Indian, by Indian companies. You can't import infrastructure, and a lot of that will get reflected in the business that the sectors that
and with Indian capital, not to forget. That's a good note to end on. Thank you so much, Ved, for joining us.
Pleasure.
We need to go in for a break, but coming back on the other side, we talk about the inflation in rural farm wages. Stay with us. Welcome back to Policy Watch. Rural wage growth has slowed down considerably, and this may have significant impact. Just to understand the numbers, 3.8% growth in November. It's the lowest since July 2005. Incidentally, wage growth has averaged around 18% for the last 5 years. What is the impact of this, not just on the rural sector, but the farm sector as well, and in a sense on the economy as a whole? To understand that, I'm joined by Shubhada, Chief Economist at Yes Bank. Shubhada, thank you very much for speaking with us. First of all, tell us, this seems to have happened somewhat suddenly, or was this a confluence of factors that were already moving into place?
I think it was a confluence of factors, but most predominantly we have to go slightly back in the history of 5 years, and we need to evaluate how the government responded to the post-global financial meltdown scenario, and that having had a very dramatic impact across the globe in terms of growth support drivers. So very clearly post-Lehman, we had seen a huge impetus being given by the government to focus on rural spending, so as to keep the consumption driver of growth intact. And as a result, if you look at the data, of the 5 years ago post Lehman, those 2 years we actually saw the annualized growth of rural wages somewhere close to 50%. If I remember FY09, there was a rural wage growth of rural spending growth of about 70%, and in the subsequent year it was almost to the tune of 35 to 40%. So if you combine the 2 years, on an average, rural spending grew on the government side by about 50%. What happened thereafter was there were clearly compulsions on the government to restrain its spending in order to maintain the fiscal discipline, and we did see, particularly in last 2 or 3 years, Govind, that how the government has been compelled to compress a lot of expenditure because of the need to adhere to the fiscal deficit targets. And that's precisely what has happened over the last 2 years, that we have actually seen annualized growth in a contraction mode and not in a positive territory. If I were to give you this current year's year to date and the past year's annualized growth rate, it was somewhere close to minus 3.6 in FY14, and year to date till November it's minus 0.5. So quite clearly the compulsions on government to maintain fiscal.
Right. So how do you see this, Shubhada? Is this something, are you saying that, for instance, when we saw almost 18% average wage growth in the last 5 years in rural wage growth, is this an aberration that had to be corrected, or is it something that is a shock in the truest sense?
I think it would be more normalizing it, because we at the end of the day we have to see wage growth adjusted to inflation. So as long as wage growth is higher than the consumer price indices, it is fine. It does not disrupt consumption in a normal scenario. As I said, that time it was a shock. The government needed to keep rural economy ticking for growth, and that's why those high percentages of rural spending, to my mind, were more of an aberration. You cannot year after year focus an extent of increase every year of 70 to 80% of rural wages, which actually spurred consumption, and as a result of which also led to food inflation moving up. So the short point is, you definitely need to support consumption, but is it through government stimulus, or is it through creating more jobs in the rural economy, and therefore consumption or the wage growth basis more on investment led activities, or it's just one-off government stimulus? I think the debate is there.
Okay, so let's focus on the impact and the outcome of this, right? So first question obviously is, what does this mean for the farm sector and for farmers in specific?
Yeah, at the outset, I would like to say, over the last few years, we have seen the farm sector as a share of rural economic activity significantly decline. It's not just farm and farm laborers that we need to benchmark our rural wages against, but besides farming, there are other allied activities in agriculture, which actually as a share, if you look at the latest NSSO data, that seems to suggest that share of farm has declined significantly. So more importantly, to concentrate on other economic activities, and one such anecdotal example that I can give you is that of construction sector. I think a lot of construction activities taking place in the rural side, which is actually supporting rural wages. So it may be a combination of a government plus private sector spending, but the fact is, consumption will get supported not just because of the farm, but also because of the expansion of rural economy besides farming and agriculture. So I think that needs to be taken into cognizance and on board when we are talking of rural wages. The second is the impact of the declining rural wages, no doubt, though not extremely dependable, but the IIP series consumption data seems to suggest, at least on the non-durable, seem to suggest that it hasn't increased. The FMCG data seems to suggest that top line is just around 5% growth or thereabouts, but consumption hasn't increased. As far as consumer durables are concerned, the consumption seems to be showing some decline. So I think that is clearly a larger part of it can be explained because of the government's sharp constraint on the spending in the rural economy over the last 2 years to maintain the discipline.
between rural in general and farm sector. What's the longer term impact of this, Shubhada, from your point of view? I mean, obviously people have lived in a certain and being used to a certain sense of income growth and wage growth, and that's not going to happen. So this obviously has more than just economic implications, isn't it?
Fair enough. I think it's definitely, a simple, maybe it sounds a very cliched answer, but the fact is that you need to take the jobs to the rural economy. We in India have a classic case of disguised unemployment in the farm sector. So obviously, government has been compelled to extend it through minimum support prices and so on. Now, let's not forget the minimum support prices over the last 2 years have also, been growing very anemically, and by a conscious policy decision of the government, under 5% or so. Prior to that, between 2009 and 12, the compounded rate of growth of minimum support prices was somewhere close to 15 to 20%. That also was adding to the consumption. In last 2 years, we have seen that. The simple plain answer is you need to create more jobs, you need to take more jobs into the rural economy, be it on agriculture and allied agriculture services like a food processing industries or other trade in services, trade forming a large part. Or a classic case of example, road building has been a great support in the hinterland as a source of revenue, as a source of earning for a rural population. We saw that happen in the, when the Golden Quadrilateral was being built, and probably in the recent evidence of construction having picked up and the road sector particularly having picked up, I think that acts as a suitable and appropriate substitute to the dwindling support of the government spending to maintain rural consumption intact. I think the way forward would be to bring in a more sustainable stimulation of rural consumption, and that should be by creation of jobs in the rural economy, be it either through government sponsored schemes or more importantly through private public partnership sponsored economic activity like infrastructure.
Right. So, Shubhada, I think you did refer to this earlier, but let me ask you again, what are the other, the corollaries that are emerging from this? Obviously, for instance, the chief economic advisor said that this was a clear sign that inflation was coming down, and obviously some of the government's efforts in that direction were paying off.
I think very clearly, inflation was a manifestation of classic supply-demand gap. The rural wages having grown, the pace at which they grew over the last few years, barring the last 2 years, kept the consumption intact, whereas the supplies were dwindling. And particularly as the rural wages increased, the protein consumption increased. So protein-related inflation continued to remain high, in turn which fueled the overall food inflation. So I think consumption and rising pattern of consumption and a higher quantum of consumption because of high rural wages in the midst of a dwindling supply or a very stable supply did not augur well for food inflation. At the moment, what's happening is, one, because of the restrained MSP hikes and the decline in rural wages, some bit of the price pressures on food have begun to ease, but that's not, we want a higher consumption, but through higher productive wages and not just stimulus. I mean, stimulus in the long run cannot be sustained. You need to associate any rural spending with in turn productivity getting associated to those wages, and that's exactly what the issue is all about. We need to bring productivity to the table, create jobs, create a further scope of economic activities to expand in the rural economy, and then I think we will be on a virtuous cycle of investment led increase in rural wages fueling consumption.
Last question, Shubhada. So going forward, I mean, does this merit a policy response in any direction in your mind, and particularly given that we still have inflation targets, at least inflation from a more sustained point of view, or is it something that, I mean, does this in some ways suggest that we've reached the end of one journey?
I would think definitely I would not want to see a policy focus once again in the form of stimulus, but if the government policies are more focused towards creating economic activity or creating jobs by pushing the creation of rural infrastructure. We had this Bharat Nirman program which has, I think, gotten abandoned, but I think some of those were 6 or 7 flagship programs to revive the rural economy through rural roads, housing, electrification, irrigation, etc. If those kind of activities are brought on fold and wages are then connected to the productivity of these assets or productivity-led creation of these assets, I think that will be a great idea.
You need more schemes designed for rural India, and which is Rural Plus Farm, but they just have to be done differently.
They have to be done differently, absolutely.
Right. Shubhada, just to come back to that last question. So, is there something more that needs to be done, or is it, I mean, is the sort of situation here already on an autopilot towards a desirable direction?
No, I would not think it's yet on autopilot. I think government will need to, bring in more efforts to, in lieu of containment of fiscal spending towards the rural economy, just as one-off stimulus. In lieu of that or against that, government will have to bring in more virtuous economic activities to the rural economy, bring in more trade-related, taking, these DMIC kind of corridors which do pass through hinterland, which would offer some creation of jobs. These kind of development projects along the rural what the government had called it rural, So bring in those kind of facilities, creation of those kind of facilities, I think the budget should be carefully crafted towards creation of those impetus which will bring in rural economy more in the fold of a virtuous cycle of wage increase because of investment, which fuels consumption and therefore adds as a support to growth.
Shubhada, we've run out of time. Thank you so much for speaking with us. Well, that's all we have time for on Policy Watch this week. We'll be back next week, same time. Thanks for watching.